This is my first webinar. I hope to find it helpful and pleasant. You are more than welcome to send me by email any question you may have, your feedback, or even general comments at the end of the webinar. I'm glad to answer all of your questions and emphasize more at your interesting parts in the next webinars. Okay, now let's go to the webinar. What we'll cover in this webinar. During this webinar, we'll first cover the objectives of market analysis. What is technical analysis and what is fundamental analysis? How fundamental news affects the market and how to trade using fundamental analysis through some examples. Before we go further, I want to make sure that everyone in this webinar understands the risk disclaimer. I'm sure you have already seen this several times. So what this tells you is that Forex trading is a risky endeavor and it does involve a significant amount of leverage, which can of course amplify your losses as your gains. So if you're not sure about anything, and certainly if you are new to this, please evaluate this very closely. Okay, so let's see how you start trading. Before you get in the market and start trading, of course, you need to settle on some facts. Let's say that you have found the best broker company for you, you have downloaded the necessary trading platform, and now you are in front of your platform. You must decide which instrument you are going to trade. You can trade a foreign exchange pair like euro-dollar, pound-dollar, pound-yen, a stock, an index, which can be FTSE 100, Dow Jones, DAX 30. You can even trade a commodity like gold, silver, or even oil. So anyone can understand what you will choose to trade is not a random choice. In this point is where the market analysis enters the game. Market analysis is the research you do to study the market and forecast the future direction of an instrument. It can be used to find trading opportunities in order to take profit. And of course, this is everyone's target, isn't it? Okay. Market analysis is separated in two major categories, also known as the two schools, the fundamental analysis and the technical analysis, two completely different approaches to the market. As I said before, in this webinar, we explain both what is technical and what is fundamental analysis, but we'll emphasize more in the fundamental. This is because my colleague Shivko Yordanov covers the technical part in another series of JFD webinars. The first webinar for technical analysis was done last week, but if you're interested, you can find it on JFD YouTube channel. The most important thing before we explain what is each kind of analysis is to specify our objectives from the market analysis. Why do we need to analyze the market? What do we really want to find out through the market analysis, except of to take profit? As I said before, you need to decide which financial instrument you will trade. You are in front of your platform and you have a lot of options of currency pairs, indices, stocks, and so many others. Using market analysis, you will pick an instrument which is the most suitable for you. For some traders, this may be the currency pair, the known to all of us Forex. For others, maybe a commodity, and so on. Okay, so after a quick research in the market, let's say that you have decided to trade Forex, for example. Which currency pair you will trade? Euro-dollar, British pound with Japanese yen, United States dollar with Canadian dollar? Again, you have many options. To decide that and many other dilemmas that you are facing, you need to know the duration of your investment. You want a short-term trading position, a long-term, or a medium-term. This depends on each trader or from the opportunity you can find in the market. For example, a trader can do both medium and long-term investments depending from the opportunities he or she finds in the market. Okay, so to sum up, Let's say that you have decided to trade Forex, the euro-dollar pair, for a medium-term position. What position you will open? Long or short? Are you going to buy the currency pair, the euro-dollar in this example, or sell it? When you will enter the market and when you will exit the market. You have to apply your method of analysis to find out your entry level, your take profit level, and your stop loss level. Here, I would like to clarify that the entry level is not necessarily the current price. It can be a later price that gives you a further confirmation sign for the direction you have forecasted. For example, you may believe that if the euro-dollar surpasses 115, the pair will gain momentum upwards towards 120. In that way, you will place your entry level at 115 or slightly above it. Take profit is the level that you will close your position and take your profit if your investment goes well. Unfortunately, as we all know, not all the positions are winning ones. You have to take losses and winnings. Just try to have more winnings positions at the end. The stop loss level is the level where you will close your position and take your losses if your investment does not go well. It's important that these three levels would be set before you enter the specific trading position to minimize psychological effects. Of course, you can change your levels later if you revise your analysis, but I would advise you to do this only if you're a professional trader. If you're a beginner, it's better to keep your initial strategy following the simple rules that you have set until you finalize your strategy as much as possible. Okay, let's go back to the subject. What is technical analysis? Technical analysis is the method of forecasting the future direction of financial assets by studying the past market data, the price, and the volume. Basically, technical analysis analysts, they study only the chart. By the way, guys, by saying financial asset, I mean any tradable security. This could be a stock, the currency pair, bonds, commodities, and many others. I will use the term financial asset or security or instrument through the webinar to keep a general tone. Okay, the technical analysis is based on three premises. The market discounts everything, prices move in trends, and that history repeats itself. Let's take the first one. On the criticism that the technical analysts do not take into account any fundamental factors that affect the price of the security, technical analysts stand by saying that the market discounts everything. What does this mean? This means that all the fundamental and the economic factors in general that affect the market, even the market psychology, are reflected on the price of the security. Thus, just a chart with the price movement is enough to forecast the future direction of the price. Second, technical analysts believe that the prices move in trends. This means that direction of the future price is more likely to be in the same direction as the current trend than to be against it. For example, if the pair is on an uptrend, which means that it's rising, then it's more likely to continue to rise rather than decline or move sideways. The third assumption is that history repeats itself. Technical analysts, based on the market psychology, they believe that the market participants tend to react with the same way on similar market events. Thus, the patterns of the price movements will be repeated at a later stage. Now, what is fundamental analysis? Fundamental analysis is the other big part of the market analysis that approaches the market using fundamentals. Specifically, fundamental analysis is the method of forecasting the future direction of the security price by studying all the fundamentals, which means all the macroeconomic factors and anything that can affect the value of the asset. Fundamental analysts have two ways to trade. One of them is to trade the fundamental news. The other one is based on the premise that the market price of an asset does not always match the true value of the asset. Let's explain the second one, which is more complicated. Basically, what fundamental traders usually do is evaluating the real value of a security and the current price of the security in order to find securities that are underpriced or overpriced and take positions. If the current price of an asset in the market is below its real value, which means that it's underpriced, then you take a long position. So you buy the underpriced securities and vice versa. When you find an overpriced security, you open a short position. Okay, this sounds a little complicated, but it's easier to understand it through the next example. Just to mention that the next example is more suitable for medium to long-term investors. Let's say that I'm a financial analyst, I manage a portfolio, and I want to invest in stocks. To decide on which stock I will invest using fundamental analysis, I find out all the data I can for the stocks. This is not easy because there are thousands of stocks, but I will start by finding a healthy country and follow the cycle you can see on your screen. For the country